Japan and the voice, the hottest topic right now. If you look at the headlines and news images these days, you'll see things like, hey, there's an energy crisis, there's a war, there's all this tension. So does it have a strong impact on the market? Yes, it does, and it's a big one. But honestly, that's just another element that's been added into the mix. The global financial game. But right at the center, like the chimney itself, it's actually Japan, isn't it? Because a huge amount of loans in the world actually come from Japan. That's right, because the global financial and economic system doesn't really run on money, it runs on debt. Companies grow massively because of credit, and if Japan's economy can't handle it, if the yen starts to weaken and Japan says, I can't take it anymore, come up, it's still not manageable. How could people who took out cold loans possibly handle it? Maybe they just can't, right? And honestly, at the point when Japan's economy couldn't take it anymore, after doing yield curve control for so long, to the point where they just couldn't keep it up anymore, and now they have to raise interest rates even faster, it's just the worst timing ever, especially with a war breaking out, hitting Japan with fire and conflict. It's like oil and fire coming together, shaking things up all at once. It'll be intense and nerve-wracking. In this video, we're gonna break it all down for you. Support the clip Japan and the Wall, the hottest moment on this planet, by scanning this QR code. And don't forget about the channel, Psy Money Monster. Or if you wanna support the Psy Money Monster channel, it's super easy. Just hit like, share, and leave a comment to chat with us. And what I'd love for you to do most of all, please hit the subscribe button for me so that when the next video comes out, we can meet again. Sounds good, right? Thank you. Let's start with the world's economic system. Over the past several decades, the term capitalism and its rapid growth has been thrown around a lot. But actually, the world doesn't run purely on a financial system. It runs on something called credit. As I mentioned, it's credit and massive amounts of loans that are used to drive the growth of the global economy. This actually comes from Japan. In other words, yes, Japan is the creditor when it comes to loans. Japan is the world's largest provider of low-cost capital. Why is that? Because the BOJ, or the Bank of Japan, once made a commitment, a promise that investors really like. They promised to keep lending interest rates low and stable. This is called yield curve control. Basically, Japan promised to maintain low and stable interest rates. How do they do that? If the rates start to rise or become unstable, the BOJ, the Bank of Japan, will just buy its own debt to push the rates back down and keep them low. So investors love to borrow from Japan. And it actually functioned remarkably well for about 10 years. But as I previously mentioned, the specific way Japan manages yield curve control is that if things aren't going well and interest rates are about to rise, the Bank of Japan simply prints more money to buy its own debt, right? And this particular method has ultimately made Japan the country with a staggeringly high volume of public debt. That figure has climbed significantly to around 220% of GDP, which is an absolutely massive amount. And with debt levels this high, even if it's just domestic debt, essentially just Japan owing the money to itself, if Japan were to raise interest rates by even just 1%, that would mean an enormous amount of additional debt. If you think that's bad, what's even worse is all the loans that Japan has given out around the world. That's even more problematic. This is called the yen carry trade. The yen carry trade is when you borrow money from Japan and use it to buy assets elsewhere. Investors make a profit only when Japan keeps its interest rates really low, and then they buy assets with higher interest rates elsewhere. That gap is the profit. But it's not just about making an easy profit from assets. There are also issues like currency exchange rates, fees, and a lot of other factors. For example, if Japan raises its interest rates even a little bit, it could cause this gap. could easily turn negative. So when investors start to panic and realize, oh, this profit gap is starting to disappear, it's not profitable anymore, it can really freak them out. And let me tell you, we're talking about a massive amount of money worldwide that's been borrowed from Japan. When investors panic like this, they might close their positions. That's what's called a yen carry trade unwind. And this has actually happened before, on August 5th, 2000. People called it, kind of casually, Black Monday. That was the day when, in just one day, the Japanese government announced they were going to raise interest rates. They only raised it by 0.25%, but it really shocked investors. It triggered what's called a yen carry trade unwind, not a huge one, but still significant. And believe it or not, just on that one day, the value of the US stock market just vanished, completely in the red, $6.4 trillion gone. So if you ask back then, when they raised it by just 0.25%, people were that shocked. Now, today, where has the yield on Japan's 10-year government bonds gone? The bond yield on Japan's 10-year government bonds has now reached 2.52%. This is the highest 10-year government bond yield Japan has seen in 29 years, since 1997. That means every time Japan raises interest rates, even by just a fraction of a percent, it means profits keep shrinking and shrinking and shrinking. Just like It's like I'm an investor who borrowed money and is now standing on the edge of a cliff, inching closer and closer to the edge. You never know when you might get pushed off. It kind of reminds me of a speed game. This is just the nature of the economy. So whenever the government tries to keep the rate steady, it's actually going against the natural flow of things. The natural order of the economy gets completely destroyed. Thailand has experienced this before during the Tom Yum Kung crisis, remember? Do you remember why the Tom Yum Kung crisis happened? It was because the Thai government tried to keep the exchange rate between the baht and the dollar stable at $1 to 25 baht. They kept it fixed like that. 1, 2, 3, 4, 5, 6, boom, it collapsed. And Japan is the same way. Their yield curve control hasn't just been going on for 6 years, but it's like they've been doing it for a really long time, like 10 years, and the signs of collapse are already there. So we'll have to wait and see if Japan can keep holding down interest rates and not let them go any higher than this, because investors are all getting really nervous now. But one thing that's for sure, in my opinion, is that Japan won't do yield curve control anymore. The one they promised, they're not doing it anymore. The yen just can't hold up anymore. People are shouting about it because right now, the yen is at 160 yen per dollar, which is the weakest it's been in 40 years. Some people say, oh, maybe a weak yen is good for trade, right? Like if Japan's currency is weak, exports should really take off. But exports aren't taking off at all. That's because the main industry that has supported Japan for so long is the automobile industry, right? But now the world has shifted to electric vehicles, and Japan has to admit that it's lost the EV game to China. They lost outright. So if we're talking about Japan's exports, they're really not doing well. And not only are they not doing well, but it's a disaster, even more so because Japan's currency is weak. But Japan is a country that has to import both food and energy. Japan imports energy, you know? According to data from the World Bank, right now, Japan has to import 87.22% of its total energy consumption, almost 90%. Let me underline this. Japan has to import almost 90% of the energy it uses nationwide. Because what I'm about to say is that even just looking at Japan's economy and finances right now, it's already like a raging fire. Things are really bad. And on top of that, there's the Iran war, the energy crisis, and Japan's own problems. A struggling economy, massive debt, and a severely weakened currency. They have to import a lot of energy, and with their own currency dropping, energy imports are already expensive. Now, with the energy crisis on top of that, Japan has announced that they will release their national emergency oil reserves. And not just a regular release, but the largest release in Japanese history. That means this is no ordinary situation. It's a real crisis. And if things have reached this point, you can already see what's happening with oil. There might be an oil shortage in Japan. If oil is in short supply, that means prices will go up. And if the price of oil rises, it might not just go up by 2, 3, or 10%, it could double or even triple. That would mean goods and services in Japan would become even more expensive. If prices go up that much, what does that mean? Expensive goods mean inflation. Inflation would likely surge. And if inflation gets that bad, the standard method that governments around the world use to fight inflation is raising interest rates. Interest rates, no matter which country raises them, it's not as scary as if Japan raises its interest rates, as I explained earlier, because it affects loans all over the world. Up until now, the Japanese government hasn't done it because they have their own reasons, which I've explained in several videos about Japan. But right now, it doesn't seem likely because the Japanese economy can't handle it either. The yen is already weak, so if you ask me, the Japanese government, they're a country made up of real people just like anywhere else. If they face a crisis, like an energy crisis or a surge in inflation, wouldn't they have to use the standard approach of raising interest rates? Is it really possible for them not to? Japan isn't some anime world, There's a real possibility that we might see Japan's policy interest rates go even higher than this. And that would mean the carry trade would cool down. If the unwind is as strong as we've talked about, it still feels difficult. Let me sum this up briefly for you again. Japan's economy is incredibly important to the world. In fact, it's possible that Japan could be the epicenter that triggers a global financial crisis. That's because, up until now, Japan has been the world's largest provider of low-interest loans. And of course, investors love that, whether it's ordinary people, financial institutions, and big companies all borrow money from Japan to invest in other assets that offer higher interest rates. This is called the yen carry trade. With this kind of investment, the investors make a profit only when Japan keeps its interest rates as low as possible. Then they buy any asset considered stable, like US government bonds, back when the interest rate was 5% or so. It's basically like, you make a profit. It's easy money, right? Even after accounting for currency exchange and other costs, you still make a profit. So when Japan raises its interest rates, it really affects people who invest this way a lot. Back then, on August 5th, 2024, Japan raised its interest rate to just 0.25%. The US market was shocked, and it triggered a Black Monday. The market lost $6.4 trillion in value. In Thailand, on that same day, it was basically a wild yen carry trade event. But anyway, right now, Japan's 10-year government bond yield has risen as high as 2.52%. This means that if the Iran war pushes us into an energy crisis and oil prices go up in Japan, there's a possibility that Japan might have to raise interest rates even more to fight inflation. And coming back to, this will affect everyone who's ever borrowed money from Japan. And it could potentially cause the market credit of the world to collapse because there could be a significant financial phenomenon called a yen carry trade unwind. For this clip, our editor will add a link to the Japanese yen story video as well, in case anyone wants to explore the situation in Japan in more depth. If you want to catch up, just watch that clip. It should only take about an hour to get a complete grasp of the situation. All right, so that's the situation with Japan, which is like a pile of kindling. Now let's move on to the oil side, which is about to fuel the fire, meaning the war side. So is there any hope in the current war situation? Because I think that if there is any hope, it's very little, because right now, Iran seems to have found a trump card to hold the world economy hostage just by using relatively cheap drones to completely shut down the Hormuz Strait for a long time. As for the US, they say they're not going to block the area since that would only make things worse. But at the moment, the US still has Navy ships stationed there to monitor and inspect anyone passing through. So right now, those who need to transport oil out of the region, are they giving up on trying? There are still some people who are making the effort. I read this in the news. The article said that when they want to send oil tankers through the Hormuz Strait, they do it in a kind of bold way. The gist of it is something like, hey, today we're going to send a ship through Hormuz, and the ship's captain. Don't worry, just get through these two things. If you make it past the first one, try going at night and don't forget to turn off the ship's headlights so it's blurry and dark, making it harder to see. The first thing you have to get past is Iran's attack drones. Oh, if you can get through that, let me tell you, you've got a 50% chance of making it. Then you just have one more obstacle, the US Navy ships, which will check and inspect you. If you can get past both of these, you're free to go deliver the oil. That's how you make money. Honestly, if I were the ship's captain, I wouldn't go. So how's the global economy doing right now? Honestly, the reason we haven't really felt the impact since the war started is because we've had a safety net. Those ships leaving the Hormuz Strait and delivering oil around the world. They kept making deliveries, but now that's over. The last ship that left the Strait of Hormuz made it out on February 28th and finished its delivery on April 20th. That means there's no more safety net from those last ships, so that's why the paper price of oil is still over $90 per barrel. But the real oil, the kind they're actually loading onto ships right now, has shot up to around $200 per barrel. We're already seeing that happen. So is the US market really benefiting from this? If anyone says America is an oil exporter, hey, look at these numbers first. The US actually exports about 4 million barrels of oil per day. But the United States actually imports over 6 million barrels of oil per day. That means the US is really an importer. It's a net importer by about 2 million barrels per day. So when the US faces trouble, it's real trouble. It's gotten to the point where the US government has to ask domestic oil drilling and production companies to ramp up their oil production, hoping that this will help ease the energy crisis and bring prices down. Even a little increase would help, but it turns out that the oil production companies in the United States just aren't having it. They refuse. They won't increase production. It's not that they want to antagonize the government, of course. It's not because they want to be in conflict with the government, but because these oil companies in the US have to look out for themselves first. They need to maintain their own financial stability. And why is that? Because the President of the United States. America is unpredictable. If I invest in drilling or increasing oil production, that means I have to spend more money to drill more, right? And if tomorrow, suddenly, there's a peace negotiation and a ceasefire, oil prices will drop. So who's going to be in trouble then? Me, that who? The ones who invested or the ones in trouble? Will the government help? No, they won't. So the question is, will they drill more? Oil companies flat out say, no, they won't drill. That's what they said. Speaking of this, the energy crisis is another thing to worry about because we're starting to see headlines about it. Europe is facing a lot of problems right now, but what I want to talk about is jet fuel for the aviation industry in Europe. Right now, it's starting to look like there won't be enough. According to Politico, the amount of fuel currently available in the European Union is only enough for 70% of airlines. That's it. And the rest? Right now, I have to say, if anyone has booked flights or is planning to fly, make sure to double check. Even in Thailand, AirAsia has already announced flight suspensions, so other airlines might follow suit. There was also a news analysis that was kind of funny, but not really. Basically, the energy crisis in Europe, with airlines unable to fly, might not be that severe if the United States agrees to sell oil to Europe. And then, who? Do you think they'll sell? Do you think they'll actually sell? I don't think so. I don't think the United States would sell to Europe. You might ask, why not? They're friends, they should help each other out, right? Come on. Friends don't tax each other that heavily. Also, we must mention another country right now to avoid ignoring Russia. President Vladimir Putin definitely won't let himself fade out of the spotlight for long, because right now, what he's doing is taking action. He's basically hammering the final nail in Europe's coffin. He's taking advantage of the current energy crisis. Russia, out of nowhere, just cut off oil from Kazakhstan that's transported through a pipeline. This pipeline has been sending oil from Russia to Europe since the Soviet era. It supplies the PCK refinery, which provides gasoline, diesel, and 90% of the heating fuel for Germany's capital city. So, looking back at the past, it might have seemed like Putin wasn't doing much. But this time, if he strikes hard just once, it could change everything for good. Putin's ultimate intention is to ensure that Europe suffers as much as possible from the ongoing conflict with Russia. It's intense. Now, let's talk about oil producers in the region. With a war like this and the Strait of Hormuz closed, what do? Do they just give up? Not at all. Everyone is fighting to survive. If they can't ship oil through Hormuz, they still need to live, so they send it around the Cape of Good Hope. When everyone has to go around the Cape, it's much farther and more expensive. Third, there are shipping jams. Right now, there's a huge problem with ships getting stuck in the Panama Canal. It's worse than the worst rush hour traffic because the congestion is massive. Stuck for 23 hours, you'd go crazy. But here, the longest ships have been stuck is 40 days. That really drives up costs. And let me tell you, when it comes to this, if it's an oil tanker, it's not so bad because oil tankers can still make a lot of money. They can sell at high prices, right? So they have the cash to pay to cut the line or whatever. But the ships that really have it tough are the ones carrying grains and food because their cargo isn't as valuable as oil. They just have to wait at the back of the line. So they end up waiting forever until their gums go dry. That's why. Right now, the cost of transporting food and grains along certain routes has already gone up by 50 to 60%. And as I've mentioned in several videos before, fertilizer prices these days are just sky high. To the moon. So what's happening right now, the war, the energy crisis, it's all turning into a domino effect, leading to another crisis, a food crisis. Thailand, which is known as a major food producer, the so-called rice bowl of the region, well, we're not a fertilizer bowl. If our farmers don't have fertilizer, they can't grow as much. And honestly, if we think about it, if our farmers who have to produce food, but the agricultural industry already has razor-thin profit margins. And now, with fertilizer prices going up, diesel prices going up, tractors run on diesel, that means extra expenses. And if I'm a farmer, I didn't factor these costs into my original production budget. But now, with costs rising this much, what does that mean? If I stubbornly keep trying to produce a lot, am I just gonna lose money? If it's like this, as a farmer, I'd rather just do nothing than keep producing and end up exhausted and losing money. So the amount of agricultural production will decrease, because the more you do, the more you might lose. And if the supply of food or agricultural products goes down, with less supply, prices will have to go up. Food will get more expensive, obviously. That's because food is one of the 4 basic necessities we all need. So this global energy crisis could turn into both a financial crisis and a hunger crisis. You could say that, really. Seriously.